Welcome to The Explainer. Today, we are going to build your financial fortress. You see, most people start their investing journey by trying to pick the next hot stock. And honestly, that's one of the biggest mistakes you can make, and it leads to this. Pretty shocking number.
2%. That's it. That is the average yearly gain for the average investor. Now you're probably asking, why so low? Well, it usually comes down to making emotional decisions and chasing tips from a friend instead of just having a solid plan. A 2% return doesn't even keep up with the cost of living, which means you're literally losing purchasing power every year.
So, to make sure we don't fall into those common traps, we're not going to just dive in head first. No, instead, we are going to build a financial fortress, piece by solid piece, before we even think about going into battle. And here's the blueprint for that fortress. First, we're going to talk about why you even need to invest. Then, we'll get into knowing yourself and your own strategy. After that, we build the foundation, we construct the portfolio, and we learn how to manage it all. And we'll wrap up with the single most important question you should be asking. So, let's get started and lay that first cornerstone, the why.
Okay, so a lot of beginners are, well, they're afraid of putting their money in the stock market. And hey, that makes total sense. They're worried about the risk of losing it all. But there's another risk, a much quieter one, that's actually way more dangerous.
It's called inflation risk, and it's the very real danger that your money, even if it's just sitting safely in a bank account, is losing its buying power day after day, as the cost of everything else just keeps going up.
Just look at this. The national average interest rate on a savings account is, well, it's basically nothing. Meanwhile, inflation, the cost of living, is chugging along at 4% or even more. So that money in your savings account, it's losing value every single year. You're getting poorer, but, safely.
Investing is how you fight back against that. It's about putting those little dollar soldiers to work for you. Instead of letting them just sleep in a bank account, you deploy them out into the world to capture growth, create more soldiers, and actually grow your purchasing power over time.
Right, so before your army of soldiers marches anywhere, you, the general, you need a strategy. And that whole strategy, it starts with understanding yourself, and it all boils down to one simple question.
And what we're talking about here is your personal risk tolerance. How much of a market roller coaster are you really willing to ride? Do those little dips in the market make your stomach churn, or are you okay with some big swings if it means you could get bigger returns?
Answering this question honestly is maybe the most important first step you can take. Seriously, being real with yourself here is a total game changer. It takes the thousands of investment options out there and shrinks them down to a manageable list that actually fits you.
Okay, listen up, because this next part is huge. Before you invest a single dollar, you have to build the walls of your financial fortress. This step is absolutely 100% non-negotiable if you want to succeed long-term.
This three-step process is your defense system. Step 1, a budget that tells you how much ammo you have to work with. Step 2, an emergency fund that protects you when life throws a curveball. And Step 3, getting rid of high-interest debt that stops you from fighting a battle you're guaranteed to lose. This whole process makes sure that a blown tire or a surprise layoff won't force you to sell your investments at the worst possible time.
All right, with your foundation secure and your walls built high, it's finally time to assemble your army. It's time to build your portfolio.
And the core principle here, the big idea is diversification. You've heard it a million times. Don't put all your eggs in one basket. Same idea. If one part of your portfolio gets hit hard, the other parts can help soften the blow and balance things out.
Here's a great way to think about it. A healthy portfolio is a lot like a healthy diet. You need a good mix of different ingredients. You need some stocks for growth, some bonds for stability, maybe some other stuff, all working together to keep you financially healthy. So how do you actually do this simply, without getting a PhD in finance? Well, for most beginners, the easiest way is to just buy a few broad market index funds or ETFs. Think of an ETF as a pre-made basket that holds hundreds or even thousands of different investments. For example, a simple portfolio could be just 3 funds, one for US stocks, one for international stocks, and one for bonds. Boom! With just 3 clicks, you can be instantly diversified.
So what about all those exciting, high-risk stocks you hear about on the news? Well, think of those as dessert. It's okay to have a little bit of dessert, right? But it should never, ever be the main course of your financial diet. Just keep it as a small, fun part of your overall plan.
Building the fortress is one thing, but you also have to maintain it. The good news is this is way easier than it sounds. In fact, it can take as little as 20 minutes once a year.
Okay, let's walk through a quick example. Let's say you start with a target plan like this one. You've decided on 30% in US stocks, 30% in international, 30% in bonds, and 10% in something else. You invest $100,000, and everything is perfectly balanced, right according to your strategy.
Now, let's fast forward 1 year. The market's done its thing, and your portfolio has actually grown to $140,000. Nice. But look, your U.S. stocks had a great year, and they've grown to be 35% of your portfolio, but your international stocks kind of slumped, and now they're only 21%. Your whole plan is out of whack.
This is where the simple magic of rebalancing comes in. All you do is sell a little bit of your US stocks, the ones that did really well, and you use that money to buy more of your international stocks to get everything back to your original 30-30-30-10 targets. Now this is the crucial part. It's a system. It automatically forces you to sell high and buy low, and it takes all the emotion out of the decision.
So after all of this, after building this incredible, logical fortress, having a diversification plan, a rebalancing system, you'd think beginners would feel pretty confident. But you know what almost every single one of them asks? The exact same question.
Yep, everybody wants to know this secret hot tip. You know, the one stock that's guaranteed to shoot to the moon and make them rich overnight.
But here's the thing. Successful long-term investors know this is precisely the wrong question to be asking. It makes you focus on a single tree instead of the whole forest. It leads to emotional decisions, to gambling, and it leads you right back into the very traps that caused that measly 2% average return we talked about at the beginning. A much, much better approach is to ask questions about your system. What are your rules for buying and selling, based on your goals, your risk tolerance, and your plan? Having a system gives you a calculated, emotion-free framework that guides every single one of your decisions.
And in the end, that's really what this all comes down to. Building your fortress first completely shifts your focus, away from gambling on random stock tips and toward methodically and patiently building real long-term wealth. It's all about strategy, not luck.